Thank you for joining us. You're listening to the Beyond 50 radio program. I'm Daniel Davis. For many of you who are approaching midlife, you're saying to yourselves, I wonder if I've got the right plan and the right path for financial security when I decide to retire in my later years. Well, you know, as the George W. Bush administration came out of 2008, they said all of a sudden, right toward the end of that administration, hey guys, we're going to need about $700 billion to bail out a financial services sector known as AIG. Otherwise, the whole world's going to collapse. I don't think a whole lot of people were really happy about that since they passed that tab off to the taxpayers. What about all those people that lost all their money in the Enron debacle just before all that as well back in 2001? What are we supposed to do when we put our money out there thinking that it's working for us when in fact it's making things a lot worse? $11 trillion were lost in personal wealth in 2008, and we tend to figure, what are we going to be able to do about that? Well, for a lot of you out there who are trying to get involved in ways to get your money to build, whether it's 401ks, IRAs, or maybe it's mutual funds, finding ways to get your money to work for you in a safe way where you can be guaranteed that it's going to be there when you need it seems to be one of those follies where we might as well just throw darts at a spinning dartboard. Joining us here on the Beyond 50 radio program today is someone who's providing an answer to that. Believe it or not, there's been a little-known financial tool out there that's been used by the wealthy for more than a century. Today, joining us on the Beyond 50 radio program today is founder of Bank on Yourself, and she's put out a challenge that she has this financial tool. If anybody can find anything better to get the kind of results that this gets for people, she'll offer $100,000 to anybody who can show anything that's even anything better. The book is Bank on Yourself, and our guest joining us here on the Beyond 50 radio program today is our guest, Pamela Yellen. Pamela, thank you for joining us here on the Beyond 50 radio program.
Well, it's my pleasure, Daniel. Thanks for having me on.
You bet. Now, I'm going to go ahead and take the Wayback Machine to the 1980s. I was involved in a company that went around preaching buy term insurance and invest the difference by breaking up whole life policies and universal policies. Interestingly enough, you know, you buy into that gospel. Seems reasonable. Now, rolling the machine up to the 2000s, I actually picked up a book by Doug Andrews, Missed Fortune 101. When he outlined what that financial tool, let's just call it whole life insurance for this matter is, but when he laid it out, he says, this is what this little-known financial tool was created for. I hit myself upside the head, and it just made sense to me. Let's talk about what we've got going on here.
Well, I think it really helps to give a very quick differentiation between the two basic types of life insurance.
Sure.
You mentioned, you know, the buy term and invest the difference, and that's the big mantra of most financial gurus and experts and financial planners for that matter. Mm-hmm. But essentially there's two basic types of life insurance policy. There's the kind you rent, and there's the kind you own. Mm-hmm. The kind you rent is what we call term insurance. And unless you happen to, I guess, get lucky and die during the term of the policy, you will have nothing to show for the money you pay in a term insurance policy. And in fact, studies have shown that 99% of all term policies never even pay a claim. And even the experts who recommend these policies have been known to say that term insurance is designed to terminate before you do.
Which makes that kind of funny when you think about it.
Exactly. I mean, and another point of it, well, the insanity of the invest the difference. Well, first of all, most people don't actually invest the difference. I mean, how many people do you think sit down and go, now, if I was going to be buying a permanent cash value life insurance policy, my premium would be this many dollars a month, but I'm only going to buy a term policy for this many dollars a month, and I'm going to take that difference and I'm going to invest it. No one does that. And if they actually did, they're probably kicking themselves at this point for having done that. So that's the term insurance. Now, the other basic type is called cash value or permanent life insurance. And this is like buying a home. The money you pay into it builds equity for you. Now, the Bank on Yourself type of life insurance policy is a specific type of whole life insurance, specifically dividend-paying whole life insurance that has a rider or option added onto it that significantly increases the growth of your cash value in the policy, especially in the early years of the policy. So you could have up to 40 times more cash value in the policy than if you were following the traditionally designed policies and the kind that Susie Orman and Dave Ramsey and everybody else rants and raves against. So those are the main differences. But as you said, as you noted in your introduction, I have found, after researching 450 different financial products, vehicles, and strategies, that this type of whole life policy can beat the pants off of any other saving or investing method or vehicle I have come across, and that's 450 of them.
Mm-hmm. Now, as I mentioned earlier about Doug Andrews' book, he outlaid, he says, how would you like to have a vehicle? And he showed something like 5 different ways that this was a way to go. And again, like I said, it was like you slap yourself upside the head and go, oh, I can see why the rich use this tool. The biggest thing, that we want to be able to see when it comes to our retirement savings is that you want to really alleviate the tax burden that you're going to be dealing with now. Let's describe how what we're talking about here has those benefits.
Well, this is where we get into another area of conventional wisdom where people don't even question what they've been taught to do. So we're all suckers. As Americans, we're suckers for deferring our taxes. Mm-hmm. And that's one of the reasons we love 401k plans and other tax-deferred plans. If we don't pay a tax today if you could pay it later. Mm-hmm. Well, let me ask you this. What direction do you, or probably most of your listeners, think tax rates are going to go over the long term?
That's an obvious one.
Okay. I don't think anybody really thinks they're going down.
Right.
So if you are successful in growing a nest egg and tax rates go up, you're only going to end up paying higher taxes on a bigger number. And actually, taxes will destroy much of the wealth that you could possibly grow in your 401k if the fees don't do it first.
That's amazing.
I know, but whoever thinks about that?
Nobody ever does.
Right. I'd rather pay my taxes now, let my money, grow tax-deferred and potentially tax-free, which is what you can do if you, through a combination of dividend withdrawals and loans against your cash value, you can, under current tax law, potentially take a tax-free income in retirement. Mm-hmm. And so I pay my taxes now because at least we know what they are.
Mm-hmm. Now, I think what's interesting, Pamela, is that, back in the day when I was involved with the company, there was one of the mantras where, why are you having to borrow your own money?
Oh, yeah.
But again, when you understand how this works, you realize, well, let's just put it to you this way. You borrow the money, you really don't have to pay it back, but it's better if you do, just mainly because it helps. It's like paying yourself back, and you'll get into that strategy here in a minute, I'm sure. But the idea is, well, if it's, let's say they're loaning it to you, and let's just pretend that it's at 8%. Well, here's the difference, folks. Would you rather borrow your money at 8% or pay the government more than 30% in capital gains? Which one do you really want to do here? So let's talk about the strategy of how Bank on Yourself actually works.
Sure. And related to what you just said, basically when you take a policy loan from a Bank on Yourself designed policy, the interest you pay ends up back in your policy. Okay. So I show that, I prove that in my book, by the way, on pages 100 to 102 of my best-selling book. I do prove that point. I show that point. But basically, this is another area where I think this comes down to a lack of proper financial education, because essentially there are 3 conventional ways of buying things. You're either going to finance them, lease them, or pay cash for them. Mm-hmm. Now, let's use an example of, say, a $25,000 car. So if you were going to finance the car, at the end of the loan payback period, you're going to have nothing to show for the money you spent except your trade-in value of your car, worth whatever it happens to be at that point. Now, some people prefer leasing because a lot of times the payment is lower. So when you complete a lease payback, you're typically going to turn the car back in, and now you've got how much to show for your money.
Mm-hmm.
You have nothing to show for your money, not even the car. And in fact, leasing is actually the least efficient way to save, to pay for something.
Mm-hmm.
So then you get people who go, you know what, I'm too smart for that. I'm not going to fall for the leasing or financing rackets. I'm going to pay cash for stuff. So let's just go back to the $25,000 car example. They start putting aside money in a savings account, a money market, a CD, and then they hit their savings goal, $25,000 or whatever it is. They pull that $25,000 out so they can go pay cash for that car. Now, how much money, how much interest are they earning on that $25,000?
Mm-hmm.
Zero.
Right.
And that's what people don't realize. You finance everything you buy. You either pay interest to someone else to use their money, or you give up the interest in an investment income you could have earned if you kept your money invested instead. The difference is, and this is why one of the reasons we call this bank on yourself, is that if you were to save up your money in a bank on yourself type policy, when you hit that $25,000 mark, you could pull your money out, borrow it out, go pay cash for the car, and your policy will continue growing as though you never touched a dime of it.
Wow. It's really fantastic. Again, like I said, I'm not trying to, for the listeners out there, say, hey, this is a way to go, which it is, but it was just when I discovered how it works, I go, well, this just makes a heck of a lot of sense versus what I conventionally thought before. And the interesting thing, as you mentioned earlier, about financial gurus is basically they don't really advocate a financial education. It's usually get out of debt and do all the basic things that everybody else is telling you to do, but you're actually going a totally different direction. I really appreciate that you said earlier a financial education. If you got one of those, you wouldn't really listen to Susie Orman. You wouldn't listen to these people out there like Dave Ramsey, although they mean well. When you really listen to the information, they'd pretty much keep you in the same wheel everybody else is in.
Well, yeah, and then, and I, at the same time, Daniel, I do want to mention that I know many people do credit people like Susie Orman and Dave Ramsey for having helped them, brighten their financial picture, do some basic things like get out of debt and so on. Then when they tell them to go ahead and invest all of those hard-earned savings in the market, and, Dave is still talking about 12%, insists that you can get a 12% a year mutual fund. There's no such thing, and there never was, which I prove on my I prove that on my website as well.
You might lose 12% a year.
Yeah. Well, have you heard the joke? What's a 12% mutual fund?
No, I haven't.
It's a fund where after you invest for a whole lot of time, you end up with 12% of the money that you invested. And actually, I got to say, I had a lot of fun doing this. I made a movie of what it would be like if we were a fly on the wall while Susie Orman and Dave Ramsey discuss Bank on Yourself. And it's on my website, on my blog at bankonyourself.com, and it is a hoot.
I'll bet it is.
So for a laugh, I would suggest people, take a look at it. But it's about having a correct financial education, as you're talking about. And, in a nutshell, what whole life insurance is it's an asset class that is increased in value during every stock market decline and every period of economic boom and bust for more than a century. And the interesting thing is that a dividend-paying whole life policy actually grows by a guaranteed and preset amount every year, every single year. And in addition, the growth is exponential. By that I mean that the growth curve actually gets better, more efficient every single year you have the policy just because you stuck with it. And that gives you some protection against inflation, which I know people are starting to worry about again. And it provides peak growth at the time you need it most, retirement, of course, and no luck, skill, or guesswork is required to make that happen.
Now, it was also pointed out, too, that insurance companies, and people say, okay, well, wait a minute, when I say this, they typically are very good about investing money to get good returns. I mean, they do it based on the numbers, they just crunch them, and actuary tables a whole bit. And they'd say, well, okay, that's fine, but what about AIG? Well, what a lot of people have to realize is that while a lot of banks were out there, creating the problems they were creating for themselves, as well as insurance companies, there are a lot of great companies that said, hey, this is nonsense. We're not going to get involved. Can you describe that for our listeners, please?
Yes, absolutely. There are actually very, very strict legal requirements that life insurance companies have about how they invest their money. They, for example, cannot do what banks do. They cannot do they can't lend out $10 for every dollar that they have in reserves. Mm-hmm. They actually they're legally required to have sufficient reserves to meet future obligations, and that all the, death claims and so on that might happen. And they invest very conservatively. There's a word that has probably kind of disappeared from the English language. It's called prudent. They invest prudently. And what many, many, many people didn't realize about the whole AIG debacle was that it had nothing to do with their life insurance subsidiaries. It was a holding company that they created specifically to do this kind of more risky investments that they did. Mm-hmm. And their life insurance subsidiaries were walled off from all of that, completely separate. Wow. But that fact got kind of covered up, mm-hmm. Because it's easy to demonize life insurance companies and, for no real reason. But that's what happened. Mm-hmm. And in fact, they said that, and this is what's happened, the life insurance companies were actually the thing that helped save AIG.
Wow, amazing. See, and that's just it, because everybody's going to say, well, I heard, or this happened, right. And they never just say, well, why don't I look in the matter a little further?
Exactly.
Quit reading Yahoo News and listening to people giving seminars that are really, the thing is, for instance, in the case when we talked about Susie Orman or Dave Ramsey, is what people don't realize is these people make money on selling books or doing radio shows, so they're already doing well on their own. The thing is, but you've got to look a little deeper into the matter yourself and not take somebody's word at it and look at the basics and the common sense. So let's talk about how Bank on Yourself works.
Well, Bank on Yourself is based on, as I mentioned, a dividend-paying whole life policy. Now, this will have a preset and guaranteed cash value increase, but then you have the potential to receive dividends. Mm-hmm. They aren't guaranteed, but the companies used by the Bank on Yourself authorized advisors have paid dividends every single year for more than 100 years, including during the Great Depression and every economic downturn we've had over that period of time. So once credited to your policy, both your guaranteed annual increase and any dividends you might receive are locked in. They don't vanish due to a market correction. Mm-hmm. And where this gives you the predictability that most retirement planning and investing methods do not, is that you will actually know the minimum guaranteed income you can take in retirement and for how long you can take it. Try doing that with the way most people invest and save.
Right.
And what I say is if you can't answer the question, what will my retirement account be worth on the day I plan to retire, you do not have a plan.
Oh, no.
I mean, the Merriam-Webster dictionary describes plan as a means of accomplishing something. Mm-hmm. There was an article that came out yesterday in the Wall Street Journal, and from a couple very well respected market strategists, and the article is titled "Hope is Not a Strategy," and that is what most people's retirement plan is. It's hope and pray.
Robert Kiyosaki, author of the best-selling series Rich Dad, Poor Dad, said his dad used to say, "Hope is for the hopeless."
I had forgotten about that quote. I'm writing that down.
Now, it's really interesting, the stories that you have in here about people, where they really start, you can get the feel that generally they said, well, we've kind of followed the advice that we've been hearing, the conventional wisdom about how to build our retirement. But basically, you get the feeling, just as you say, is that they didn't really have a plan. They had an idea of what they thought they wanted to achieve, mm-hmm. but as you said, it really wasn't a plan. Now, Bank on Yourself, generally helps people lay out what their goals are, what they plan to achieve, and then says, well, this is how we can get there. And that's usually the first start, is being able to sit down and plan something that's really going to get you in the direction you want to go. After all, you don't jump in a race car if you don't have somebody to coach you to figure out how you're going to do several laps and get to the finish line first. Now, talk about how this Bank on Yourself has actually began to work for people and how it's changed their lives.
Well, what people say, and of course, I walk my talk. I have quite a number of these policies myself, and I'm constantly adding new ones as my ability to do that increases, or my need, etc. But it has given people that peace of mind that they finally have financial security and financial peace of mind, that they know, I already know what my policy is going to be worth at minimum next year, and the year after, and 30 years from now, and 60 years from now, and that there's just nothing that compares with that.
Mm-hmm.
If I still have money in a pension plan, I wish I'd never started it, but I did, and then you find out getting out of those plans is not easy. And you don't have
expensive.
It's expensive, and you don't have control. The government actually controls your money in qualified plans and other pension plans. And if it wasn't for our Bank on Yourself policies, my husband and I would be in the same boat as most people, wondering if we'd ever be able to retire and what we would have to give up to do so. So I get letters of gratitude every single day. I have an entire file cabinet bulging full of these letters of people who were saying, thank you for alerting them to this, because it's been around for everybody forever, but nobody's, none of the experts are really talking about it. And, then when you need access to capital, you need an emergency cash reserve, you have it. Because one of the big things we found out in this crisis that we've had is that when you're relying on other people's money, you're in trouble. Mark Twain noted that a banker is a fellow who lends you his umbrella when the sun is shining, but wants it back the minute it begins to rain. So all of us, we had credit cards, we had even a line of credit, we have a mortgage, a car, whatever it is. What we found out is that they could change the deal on us. They could refuse to give us money when we need it. Business owners, many of my colleagues who are business owners, found they couldn't get capital to expand their business, grow their business, and so on. When you have a Bank on Yourself policy and you want access to your equity in the plan, there's only one question you need to answer.
Mm-hmm.
How much do you want? Oh, and then there's, where would you like us to send it?
Right.
As opposed to filling out these nosy credit applications. Then if you miss a pay, worrying about what if something happens? I lose my job, or I get sick and I can't pay back my bills every single month. Well, you set the repayment schedule with a Bank on Yourself policy, not someone else. If you have to skip a payment, or even a few payments are cut back, you can do so. And no credit, collectors are going to call. You're not going to get any goon squads coming to repossess your stuff or foreclose on your house. You're not going to, lose your firstborn. None of that.
Yeah, you can see why people have such an attitude against borrowing money from other people. I mean,
right.
Sometimes it's even worse than the mob.
Right.
Now, let's talk about why, let's call it whole life insurance, has gotten a bad rap. Now, again, like I said, when I first read about why these vehicles were created, as you have mentioned about a century ago, I thought, okay, this makes a lot of sense, but now I'm a little apprehensive of going out there because I'm not so sure I'm going to find somebody in the financial services industry, and I don't mean this about everybody, but find the right person that understands what I'm talking about for this to do what I've understood this thing to be able to do. So why has whole life insurance, or call it universal life, gotten the kind of rap that it has with people?
On my website, bankonyourself.com, on the right-hand side, you can click on Susie and Dave, Let's Debate. And what I've done there is I have actually shown specifically with examples of my own policy statements how this type of policy differs from what Susie, Dave, and every other financial expert talks about. For example, they talk about how your death policies, whole life policies, where your death benefit stays level. And they also rant and rave about the fact that if you were to die, the company would pay your family the death benefit, but they keep, or they love the word, they confiscate your cash value, your savings.
Mm-hmm.
Well, on the website, I show how bank on yourself policies are completely different from that. And in fact, like for example, one of the policies I have up there, I show that the death benefit started at $250,000, but is now $380,000. The death benefit is growing. And I also show that if I were to have died on the date of that policy statement, the date that policy statement was issued, my family would have earned the original death benefit of the policy plus every penny of cash value it had plus an extra $14,000.
Wow.
So it's completely different.
Mm-hmm. And let's just take the death benefit ratio or example that you just gave versus the money that you've put into it. Let's say that you've been paying into a policy and you've built up $8,000 worth of equity, which almost seems to be the norm, I guess, in the basic things that are out there. But, I said to myself, well, really, let's look at apples to apples here. Okay, so you've paid in, you've got $8,000 worth of cash value with inside your insurance. You unfortunately pass, and your family gets $250,000, and they're worried about $8,000. I said, I don't know about you, but I'll take it.
Exactly.
Just on common sense alone, keep the $8,000 if you're going to give my family $250,000. It just, so you look at the kind of nonsense, but that's some of the arguments that are floating around out there, and you go, that doesn't even make sense to even have that argument.
Well,
but in your case,
right.
you've kind of alleviated that argument altogether.
Yeah,
so.
But I would agree with you, and people don't have that same expectation about other things that they would invest their money in.
Right.
But yes, it's a completely ridiculous argument, and yet we can show that a bank on yourself type policy will totally blow that argument, both of the arguments about this, and the argument that your cash value grows so slowly is blown out of the water by the fact that we add this paid up additions rider to it. And a portion of your premium goes into that rider, and it makes the cash value grow much, much faster. So why hasn't your insurance agent told you about this other than the fact that he or she doesn't understand it? Well, they have to take a 50 to 70% pay cut to structure a policy this way. And not all of them will do that.
I was just thinking, gee whiz, let's find out the motivations of why somebody isn't doing the thing that you want them to do.
Well, that's one reason, but I'll also say, and I even excuse Susie and Dave for these things, that this strategy is not taught in all the courses and the training that advisors and insurance agents have to take to get their licenses and their designations. There are relatively few companies, probably only about less than 10 companies that even offer this type of policy that really works best to maximize the concept. And so they just never heard about it. That doesn't excuse the fact that they're not willing to open their minds to it now, but they've just never heard of it. And there's no training on it, which is, why you said, how do you find the right person? It's hard because most of them don't understand. They were never taught how this policy works. They don't know what companies to use. They don't know how to structure the policies. If you structure them wrong, they won't grow anywhere near as quickly, and you could lose the tax advantages if they're structured incorrectly. So a few years ago, we realized there was a need for a bank on yourself authorized advisor training program, and now there's about 200 advisors in the country who have passed those requirements.
Now, this has really changed a lot of things. It's almost like, its own undercurrent movement, where all of a sudden now, what are people who are running around saying, buy term and invest the difference thinking now? What are people who are beginning to say, well, after 2008, I'm going to wake up and try to understand finance better. It's amazing how we'll sit there and we'll spend so much time trying to get the best deal we can on a car, but when it comes to retirement plans, I'll just leave that up to somebody else, and you think... Can
I address that?
Please.
I'll leave it up to somebody else. All right. Well, my husband and I have been investing in the market and various other things since 1987. And, we just, no matter what we did, we could not figure out how to come even close to what they said were the long-term gains you were supposed to be able to get in these investments.
Mm-hmm.
So we decided it's us. Let's go hire the country's top financial planners, asset managers, et cetera, and let them manage it. So what we did is we went to the major publications, Fortune magazine, Money magazine, Worth magazine, and usually once a year or so, those publications will have an article, the 10 best financial planners or asset managers in the country. So we researched them all. We interviewed them. We did due diligence. We checked with their references, and we ended up hiring 3 of these top advisors in the country over about a 12-year period. And all 3 of them not only charged us a whole lot to do this, but all 3 of them lost us money during what turned out to be the longest-running bull market in history.
My goodness.
A monkey throwing darts could have done that.
Right.
You know? So, and what I found after that is that 80% of all mutual funds and 80% of all advisors underperform the overall market, and many do so with significantly more risk and volatility. 80%.
Mm-hmm. Fascinating stuff. Now, you have a lot of great stories in here on people who came to understand how this program works and how they began to use it. And what's really fascinating about the stories is you begin to realize, if you implement this right, if you just do it just right, which is what, the advisors of Bank on Yourself help people do, you really start eliminating getting involved with banks. Not that there's anything wrong with having a little savings in there for liquid, but these things are just almost as liquid as going down to the bank and withdrawing your money. The fact is you don't have to deal with all the nonsense, as you said, the way that you become depersonalized, if you miss a payment or, you've got a late payment, so we've got all these different rules and regulations that are going to help us maximize how much money we're going to get from you not paying us. See, and you kind of wonder sometimes why people don't just walk away from banks in the way that they treat customers. I mean, if you went into a restaurant and your server treated you the way that banks treat people sometimes, you don't go back to that restaurant, but I think people are just getting fed up. But talk about some of these stories here on people begin to realize how the value of banking on yourself through this program really works. When it comes to loans and college education, cars, vacations, it's really quite miraculous how people start seeing, man, if I just take control, if I get, a financial education and go the right direction, it's amazing the freedom that somebody really begins to feel.
Yeah, and it's really just that people haven't been taught that there's an alternative.
Mm-hmm.
So we're showing people how to reduce or eliminate the control that banks and finance companies have over them. For example, my grandchildren. We have 2 grandchildren, and my husband and I started policies for them when they were, I believe, 3 and 6. We probably should have started even earlier, but the idea being that they would help cover their college education, and they will be able to use the equity in these policies once we have determined that they have financial responsibility. They've demonstrated that they can be financially responsible. And by the way, we would determine that by having them borrow the money in their policy for something, maybe they want to use car or something for school or whatever, when they get a little older,
mm-hmm.
and setting a repayment schedule to the policy and successfully completing the repayment schedule. That's one of the things that we would say, now they're demonstrating financial responsibility and that they understand how this works. Because, you do want to pay the policy back. I mean, unless you're taking retirement income. People don't think about that. If you borrowed money from an outside finance company, and you didn't pay it back, well, that's basically stealing.
Mm-hmm.
Stealing from the financial institution. But if you borrow from yourself, in the case of your own whole life policy, and you don't pay it back, which you don't have to do, but if you don't, well, now you're stealing from yourself.
Mm-hmm.
And the minute people get that, they become extremely disciplined about wanting to pay their policies back. So the grandkids could use it to pay for her wedding, to start a little company if they wanted. I mean, they could use it for any of those things and still, potentially have the funds there to cover their college education. And it beats, saving in a 529 plan. You don't have any of those restrictions. It's not based on the stock market. You're going to have the predictability. We're going to have at least this much available in year whatever to pay for their college education. Mm-hmm. So people are using this for everything. They're using it for college funding, for all of their major purchases, and for charitable reasons as well. We have some stories in the book about how people use it for various charitable endeavors and to start businesses and so on.
Mm-hmm. Now, what I really found interesting, too, about this program is that it basically is set up in such a unique way that it's described that if you left the money alone, if you never touched it, that would grow very nicely. But if you actually begin to utilize the funds, like, say, borrow it for whether it's vacations, college education, starting a business, buying a new car, whatever the case is, that you'll actually find that you'll even make more money by the end of the road. Now, describe that contrast, because I think a lot of people scratch their head and go, well, that doesn't make any sense.
Exactly. Well, the way it works is, I mentioned earlier that if you were to take a policy loan and pay it back with interest, you ultimately are going to have the interest along with the payments that you made back in your plan. And the way that works is that assumes that you're doing it at the interest rate that the company charges. And just as a matter of interest, insurance companies many of them charge a variable rate, but it is traditionally and typically lower than conventional finance rates. So it's below market rates. So, but the money, it doesn't really matter what you're paying because the money is going to end up back in your policy anyway.
Right.
So then, if a policy is structured properly with that paid-up additions rider that I mentioned, that's the option that makes the cash value grow a lot faster. What happens is we recommend people pay back the loan at a higher, let's say the company, right now one company is charging like 5% or something like that. Well, let's throw in an extra $25 each month or an extra $50 each month and direct that money into the paid-up additions rider, because that rider is the most efficient part of the policy. And so, that's one of the things that the advisors help their clients with to figure out how they might be able to supercharge the growth by just making a small extra payment that goes directly into the paid-up addition rider. An interesting story, my sister-in-law was here. Sister and brother-in-law were here for the weekend, this past weekend. And she started her first Bank on Yourself policy, I believe, 5 years ago. She had never used it to borrow from it or to purchase anything, but she had just finished taking her first policy loan about a month ago. She lives in Arizona, where they have all these incentives going on right now. The local utility, if you upgrade with solar, right, with solar electric heater. So she upgraded with a solar electric heater. She borrowed $23,500 from the policy, and she was able to actually take advantage of an opportunity that's already expired, but to get back every single penny she paid for the solar heater through the credits that the local utility and the state and the federal government are providing right now, and to knock down her electric bill by hundreds of dollars every single month.
Wow.
And so then she used some of the other money to upgrade their patio. So they added a barbecue, they paved it, they added landscaping. She's paying it back to the policy. She set up a 5-year repayment plan. When she finishes that, she'll have all the money back in the plan, plus the interest that she paid, and she has everything that she bought with it as well.
Not to mention, if she misses a payment, she's not going to get a statement. Oh, we decided to give you a $50 late payment fee.
Right.
You know, we're increasing
Exactly.
the percentage rate on your loan. Sorry about your luck, but
right.
it was down there in the fine print.
No late fees and no dings on your credit report.
Uh-huh. Now, it's such a very interesting and unique tool, and you think about, you know, the benefits of being a business owner, for instance, and being able to put your profits or whatever the case is into something like this, because again, it's a great tax shelter as well. Describe the benefits of how that is.
Well, yes. Business owners, myself included, I have used quite a bit of the cash values to finance business expansion. And when my book came out a year and a half ago and it hit the bestseller list, I wanted to upgrade a lot of I wanted to upgrade my website. I wanted to upgrade some software. We upgraded a lot of things. Mm-hmm. And that was right during the middle of the crisis, and none of my colleagues could get any money no matter how good their credit had been, no matter how many years they'd had a relationship with their banker. And I borrowed well into the six-figure amount from my policies by just saying this is how much I want. And the interest, for when you use it for business purposes or investment purposes, the interest is deductible as well. So, of course, I'm not a tax accountant. I'm not a, that's not my area of expertise. You want to check with your tax accountant, but that is, the way the tax code is written. Mm-hmm. And so many business owners are using it even as an alternative to traditional retirement plans. They're even offering it to their employees as a, rather than, say, funding some sort of retirement plan, they'll offer them to help with funding a bank on yourself type policy. I have one policy that we used as a buy-sell, that you can use it for a buy-sell agreement within a business so that my partners wouldn't have to go into business with my husband if something happened to me, for example. Key man insurance, it's a great way to attract and retain key employees. All of those things can be used.
Very exciting. I know that there's a friend of mine who actually was working at a hotel, and he was putting money into, I think it was an IRA, and it turned out that it was time for him to actually have to leave that company. Well, he had to also close down his IRA because a lot of these are company-sponsored 401k IRA benefits for the company that you work for. Unfortunately, because he had to pull that out, he ended up with a $35,000 tax liability. Gee whiz, that's what you call really banking on getting your retirement, taken care of here. Right. The beauty of a plan like this is it's very buoyant. It follows you no matter where you go, whether you're working for someone or whether you're in business for yourself. And so you can see why just even that benefit alone would be very valuable.
Well, absolutely. And I actually just did co-wrote an expose with Pulitzer Prize-nominated journalist Dean Rothbart on the 401k, and in that article we showed how you're going to have to get at least an 8 to 10% annual return just to preserve the money you put into the plan. That's not when you factor in the cost, the taxes, and the inflation. And that's what you're going to have to get just to stay even, which is really, really scary.
Yeah,
I mean, how many people really believe there? And that's, you're going to have to get more than that if you actually want to have a profit to show for it.
And even more amazing when you think about that particular percentage rate is Warren Buffett, considered the greatest investor of all time. He was an unusual phenomenon, but that's what he focused on was how all this works. And he was averaging something like 24% every year for more than 30 years. Now, they're trying to say that you've got to at least average half of that. And it's not happening.
Not happening. Not happening.
Now, Pamela, if you could for our listeners, now, is this something that everyone can use or talk about, say, the criteria of this for, the person listening in, this sounds really fantastic, I want to get involved, but, is this really for everyone?
Well, it's if you live beyond your means and you're not willing to change that habit, it's not going to be for you. If you feel you have little or no self-discipline, it might not be for you. And you're not ready or willing to make changes. But as far as like age and income, people of all ages and incomes use it. We recommend you not rule yourself out because of age or even health, because there are options for people in poor health, and there are options for people that are older as well. There are different variations of the policy types that older people can use that can give them some wonderful benefits and some guarantees and so on. And so, you can request with no cost and no obligation an analysis from one of the 200 Bank on Yourself authorized advisors at bankonyourself.com and find out what a plan would look like. You can actually find out your bottom line numbers and results that you would get if you were to add Bank on Yourself to your financial plan. It's not like with a mutual fund or with a 401k where you have no clue what the bottom line results are going to be because they haven't added the fees in. You don't know what the return's going to be. These are bottom line results. And they'll let you know if you don't really qualify or the age or the health is a problem, and they're also experts at helping people restructure their finances to help them free up more money to help fund the plan. And we find in many, many cases that they are able to free up some money for the person to start a plan without even affecting their lifestyle. Now, sometimes you will want to change the lifestyle. You might, want to cut back on some things. I mean, in the book, there's a couple that just stopped eating out as frequently. They started eating at home, and they said it turned out to have a wonderful benefit because they were healthier and they had more quality family time with their kids.
Very exciting. I think you hit on a very big key point for our listeners out there, too. If you're somebody that has basically a habit, for instance, of, as you said, living beyond their means, or you're someone that just really lives the I need immediate gratification, otherwise I'm not getting any results kind of a situation, this wouldn't be for you. Now let's talk about the discipline and the time frame that a person could expect when they get involved with something like a Bank on Yourself plan.
Well, you can actually start having cash available in your plan to use as you see fit. We don't necessarily recommend that you use it in the first month, but within 21 days you'll have some cash value. So you start to get a feel for it right away. And some people have used their policies, pretty quickly after starting them, and that is an option that you have. You just want to be very careful that you do pay them back in the early years, because if you don't, there's not enough cash value or dividends to support the policy if you go a long time without paying and the loans back, and it could cause the policy to lapse. So you don't want that to happen. But people get very excited about it because they start seeing results in the first year. They see that they have cash value. They see that that they have this guaranteed minimum. They know that next year they're going to have X amount of guaranteed minimum of growth, and since they also get dividends, which again they're not guaranteed, but they've been paid every single year, then they get these they get the surprise. They get to go, gee, but it's always a pleasant surprise, because look at the dividend I got. And it's not like what most people experience with the way they've been investing, where they don't even want to open their statements a lot of the time.
Oh no, it's that again.
Yeah, I mean this is a statement that always has good news and never any ugly surprises. People love that. What a difference that makes in how you sleep at night.
Pamela, too, which you also hit on, interestingly enough, as you said, dividends aren't guaranteed, but hey, that's extra cash. But the fact is, you say, let's take a look at the track record. Now, back to Warren Buffett again. He generally doesn't invest in companies unless they have a minimum of 10 years of a track record to find out whether or not they're even worth getting involved with. So he goes into companies that generally he can actually bank on consistent results and say, okay, this would be a company I'd invest in. Why wouldn't you be involved in something that has a track record such as what you're talking about over a period of 100 years? See, that makes a lot of sense. Yeah, or even 200.
Exactly. And, I do have several articles on my blog that explain exactly how the companies invest and why they would, why they are likely to do very well regardless of whether we have deflation, inflation. It doesn't really matter. And I've explained all those things in details on my website if anyone has some concerns about that. Which I understand. People do have concerns. We don't know where the economy is going. We don't know what's going to happen because of all the debt, like you mentioned at the beginning. There is one thing I wanted to mention, and that is, do you remember the scene from the 1983 movie classic, The Big Chill?
The Big Chill, you bet.
Where the character that was played by Jeff Goldblum asks, have you ever gone a week without a rationalization?
It's even better than sex.
Right, you got it. I wasn't going to say that, but I knew you knew it.
One of my favorite movies, actually, there, yeah. Well,
yes.
Very exciting. We've been broadcasting our show for about 7 years, and when we decided when it came to business basics and finance, I said, I want to be doing programs that are a lot different than all the stuff that you're hearing out there. Having best-selling authors such as yourself, and even Kiyosaki's been on the program, and Mary Buffett, and people, they start going, really, you guys talk about those kind of things? And it's, yeah, because I'm getting tired of people basically parroting what everybody else is saying, but yet everybody's getting the same results. They're frustrated, they're unhappy, they're uncertain. And, the idea is to get you in a mode that you could learn to take the first step toward learning how to make better decisions is what it really comes down to. And, I can see how a program like this, you can't really lose because you begin to take that fiscal responsibility that you've been talking about.
Yes, which you're banking on yourself. It's the one thing we ought to have learned by now is you cannot rely on the government, cannot rely on your employer, you cannot really rely on anyone else for true financial security. You have to take back control. You have to be the one in charge. Because no one has as much invested in your success as you.
Exactly. I think I always find it interesting when you hear the stories on the news about somebody, that have lost their money in their retirement funds and it's somebody else's fault. It's like, but you still signed the papers, so where's your responsibility here?
Right.
Kind of a thing. Now, Pamela, again, go ahead and give out your website and tell people, what they could do to at least find out more about this.
There's quite a bit of information on our website at bankonyourself.com. There's a little button you can click on to get our free report on how to grow and protect your wealth even when stocks, real estate, and other investments tumble. My New York Times best-selling book is available there for less than you can get it anywhere else, under $10. And there is a place where you can actually request a free Bank on Yourself analysis and get a referral to a Bank on Yourself advisor. And I encourage people to take my $100,000 challenge that you mentioned at the beginning, which is that if you feel you have a different financial strategy or product that can match or beat the benefits of Bank on Yourself, the first person who can do that, I will pay a $100,000 cash reward.
And has anybody taken that challenge yet?
They have.
Okay, tell me at least one story of how that turned out.
Well, thousands and thousands of people have taken the challenge, and most have come not even close. I mean, they can't even touch it. And what they then realize is, they were able to educate themselves on some of the myths and misinformation they have about this type of policy. And the closest anyone has come is basically saying, well, I have something, and they won't tell you what it is. They say it's proprietary.
Right.
And I'm like, well,
to sign a disclosure agreement for the next 120 years, yeah.
Right, and since I say that, that I'm going to, if there is a winner, I'm going to reveal it. I would want to share that. I'd want to implement it myself, and I'd want to share it with everyone on, who visits our website and is on our e-zine list and so on. And so that's one of the stipulations is I have to be able to share this if it wins. If it is indeed better. But so far nobody's even come close.
And like I said, Pamela, early in the program, I came to find out about these after, that conventional ideal back in the 80s of the buy term, invest the difference. And when it was laid out in that particular book by this other author, I thought, this makes a lot of sense, but yet I didn't know how to step out there and find the right person to do what he was describing. As he says, you want to talk to an advisor and call them investment-grade life insurance contracts, basically, is what he was
Right.
calling them. And when he laid out how they work, I go, this just made a lot of sense to me. So for those out there who are thinking, this is too good to be true, it's not like that at all. It's just too much common sense that makes it seem too good to be true.
Now, I do differ somewhat with Doug Andrews and
Right.
Miss Fortune approach in that the universal life policy is not as appropriate for borrowing. There can be the policy can collapse on you. There's no type of policy that comes with as many guarantees as a whole life policy. The only thing, moving part in a whole life policy that isn't guaranteed is the dividend. And that's not true of universal life. And people, as far as I'm concerned, they're already taking enough risk. They're already gambling enough.
Yeah, and the only reason I brought him up is to say, hey, somebody else out there is saying this is a direction to be considering.
Absolutely. It's really just a question of which tool we
right,
is the best one.
Well, Pamela, thank you for joining us here on the Beyond 50 radio program. It's a pleasure to have people who don't parrot but actually are the parrots, so to speak.
Well, this was a fabulous and very entertaining and interesting interview. You're very knowledgeable about this, much more knowledgeable than many people, and I've really enjoyed this. I hope it was of value to your listeners.
Oh, absolutely it was. In fact, we might even visit this down the road just to re-invite listeners to say, well, are you still doing what you were doing and still getting what you're getting? Time to maybe turn the wheel on the car and drive a different direction.
I'd be delighted.
The book is Bank on Yourself, and our guest today, Pamela Yellen. Go ahead and give out your website one more time.
bankonyourself.com. That's bankonyourself.com.
Thank you again for being on the program.
Thank you, Daniel. Have a great day.
You too. We encourage you, the listeners, also to visit us at our website, where we're also going to have this information available as a hot link and archive the show as well on our blog. Beyond50radio.com is the website. That is the number 50. Sign up for our free weekly e-newsletter as well. We thank you for tuning in. I'm Daniel Davis, and remember, live your day past halfway.